I think my device is having some fussy issues with audio. All right, can you guys all hear me now? Hopefully that's a little bit better. I don't know why we had some technical issues with the audio, but thanks for the note. So just kind of jumping in again. Thank you all for joining me for our monthly live update. I'm going to be going over the latest stats for houses and condos. Chat a little bit about the fact that the market is homes are selling faster than last year, which is a little bit surprising. We're going to chat a little bit about investors exiting the market. And then, of course, chat with David LaRock, as always, who's joining us to chat about the latest mortgage trends. So we're going to kick things off. As always, anyone who has any more specific questions, feel free to connect with me, either ask John at movesmartly.com or you go to movesmartly.com/meet John to set up a consultation. Of course, we'll go over some of your questions here. If there's anything more specific or personal, we can kind of do that in a more personalized consultation. I have a monthly webinar which I've been chatting about on top 10 home buying strategies. I said last month I'm going to update it, which I have not yet, but I'm going to update it over the next week or so to chat a little bit about some of the differences when someone's buying a home in a slowing market. I mean, the approaches, the strategies are actually quite different. So I definitely need to kind of add some new content. So if you've kind of received the old link in the past and have viewed it, hopefully in the next couple of weeks, I'm going to update it with some thoughts and insights into what's going on when the market's cooling. So anyways, you can find that in the show notes and the links below. So moving forward to the latest trends in the market for low-rise houses. And I'm going to look at some stats specifically for detached homes just to start. And when we look at the number of sales for detached homes for the month of September, we were at the lowest on record. So 2,150 homes sold for the month of November, detached homes. That's the lowest on record. The average is 3,700. So, the one factor that's driving the cool down in the housing market right now, especially low-rise detached, is that it's tough to buy a home when rates are over 6%. That's weighing on demand. And that's kind of the big factor we're seeing on the ground right now with sales cooling. When we look at the volume of new listings for detached homes, they were about 7,500-ish. Which is in line with the 10-year average. So, we have kind of average listing volume and record low sales volume, and that's really weighing on the market. Inventory levels, sort of active listings, are also in line with historical numbers at just over 8,500, which is very typical for the month of September. Now, the big thing, again, I think when we look at the market, we've talked about here is this relationship between supply and demand, sort of the months of inventory, and that has, climbed to just under 4. So we had just over 1 month of inventory in the spring market that has climbed pretty rapidly to just under 4 months of inventory, which is kind of roughly where we were at after the market crashed in 2017, when the stress tests were introduced in 2018. We were right around kind of just around 4 months of inventory or so, and that's kind of where we're at now. Looking at prices for low-rise homes, I'd say are relatively flat. I mean, they picked up a little bit over August. I think that's a little bit of seasonality. We're at about 1.367 million, which is below where we were even in the spring 4 months ago. So prices have actually dipped, and I think one thing, when I talk about updating, 1 second. Someone's saying there's no volume. Can everyone hear me okay? One thing when we talk about, let me see here. Yeah, okay. So when we talk about, prices and comparables, one important thing to kind of keep in mind is that, when we're looking at comparables, we want to be looking at the most recent ones. If prices have dipped a little bit since since the spring comparables are not as relevant because prices are down, say, 10%. So, this is one thing that we need to be mindful of when we're looking at both either buying or selling a home in a slowing market. I mean, you had a client who's looking at buying and selling, and the comparables for the home that they were buying, the only good ones were from May. So we had to sort of factor that into account and suggest that maybe we need to be looking at a sort of a price reduction from that. And similarly with their home, the price or this projected sale price is lower today than what it would have been 4 months ago when we were looking. So these are, I think, important considerations to keep in mind when you're looking at buying or selling in today's market. Moving forward, looking at the condo market. So the condo market's kind of a little bit different. I mean, sales are also low. I mean, we had about just 1,300 sales, which is below sort of the 10-year average, about 2,000. It's not like a record low the way it was for detached homes. The one big difference with the condo market is that, condo new listings were relatively average, whereas new listings for detached were relatively average, but new listings for condos are close to a record high. The only year that was higher for the month of September was in 2020, which we saw this big surge in new listings due to COVID. So aside from that, we're pretty much at a record high, about 5,000 condo listings in September, new listings. Typically, we see about 4,000. When we look at active listings, we had about 6,500 active listings. Last month, the typical average is closer to 5,000. And we're seeing, again, months of inventory kind of surge rapidly. We went from about 1.5 months of inventory in the spring to about 5 months right now. And again, some stability in prices. And, the one thing I'll say, when we think about where the market's going, and I probably should have had a separate section on this, but it's this relationship between new listings and sales that's going to be super important. If new listings continue to actively, accelerate rapidly, and sales remain very low, we're going to see inventory build up, which might put pressure on prices. If sellers kind of pull back and don't list as much, then we might see inventory levels kind of plateau and some stability. So hard to say where we're going to go, but I think that's going to be the most important thing to keep an eye on. So when I was kind of doing a couple presentations over the past few weeks, and one thing I wanted to look at was how long homes have been taking to sell. And my expectation was when I did this that homes are taking a lot longer than last year. You're seeing a lot of sellers relist their home, so they have the home for sale in the summer. It doesn't sell in August. They take it off the market, relist it in September. So when we look at the number of days a home is on the market, we got to look at the cumulative days on market for all listings, not just the last listing when it's sold. And when I did that, I was a bit surprised to see that in 2023, both houses and condos are actually selling faster than September of last year. So that's a surprising result. So about, the average days on market for listings this year for houses was about 27-ish, compared to about 34 last year. So they're selling faster. Condos take a little bit longer, just over 35 days on market compared to about 40 last year. And when I looked at, I was curious to see how many homes are selling in the first couple of weeks, because I mean, we see this in the ground, even though the market's slower, there are some homes that sell very quickly. And again, was a bit surprised to see that, in the low rise market, just over 50% of houses are selling in the first 2 weeks. And that includes all previous listings. So includes if homes were relisted multiple times, which is faster than last year. Last year is closer to about 47%. And again, similarly, condos, about 35-ish% or so are selling within 2 weeks. Compared to about 31% last year, so a bit faster. So why is this happening? I suspect the big factor is today's sellers are adjusting to the market faster. And what I mean by that is they are adjusting to the slightly lower prices compared to the spring, whereas last year prices crashed about 20% between the spring and the summer. So I think it was probably a lot harder for sellers to sort of adjust their expectations down, which is why some homes are sitting on the market a little bit longer. So, and I think that what that's telling us is homes that are priced well are, moving relatively quickly. I mean, selling in 2 weeks is not bad. But there are certainly some homes and in some markets where there is a lot of inventory, and homes are sitting on the market longer. So this is not I'm not trying to argue that the market's booming, just that some homes surprisingly are selling quickly. And I think this is, again, one of the hard things to sort of make sense of the market when you're looking and you see all these stories about the market slowing down and sluggish prices. And then you're looking in some neighborhoods when homes are selling within a week and they're still getting multiple offers and selling for, reasonable prices. So I think it's very regional. I think this is, again, one of the challenging things when we're looking at buying or selling in a sluggish market, where we're looking at buying or selling and the type of property is going to be super important. Moving on, just a couple of stats on, or one kind of key stat on investors selling. So one thing I've noticed anecdotally over the past while is a lot of investors reaching out to us who are looking at selling 1 or 2 properties. Most of these investors have multiple properties, and they're just looking at deleveraging. So again, when I see these anecdotes or hear these anecdotes, and I've heard a lot of agents sharing the same stories as well. And in our case, from my experience, not all of them do list, some of them do. And if they don't get the price they want, they just end up renting it. Some just wait and are just doing their research. So it's not like everyone's rushing to sell, but it's still noteworthy to get a lot of calls from investors. So when we look at the stats, we can estimate roughly how many homes are being sold by investors by looking at the MLS and basically saying, okay, out of all the homes, say, that sold in September, let's look back in time and check to see what was the last transaction on that property. If the last transaction was a rental listing, then we have some good indication that that was actually, owned by an investor who had it rented for a little while and then decided to sell it. Whereas if there's no historical rental transaction, the last transaction was a sale, then we're going to assume that it was owner occupied. Again, there are exceptions, obviously, to these rules. It's not perfect, but it gives us a good indication. So I focused on the city of Toronto's condo market because that is typically where we see the strongest investor activity. And what we find is that investors are, in fact, selling at a faster rate. So, typically we would see about, anywhere from 20 to 25% of all sale transactions in a given month be investors. And that's creeping up over 30% in September 2023, so about 32%-ish or so. So definitely we're seeing an increase. Again, it's not a fire sale. It's not like everyone's rushing to exit the market. And we can kind of see this by the thousands of units that were still listed for rent. But in a slowing market, you don't need every investor to exit the market. I mean, even a few hundred or 150 or 200 a month is enough to kind of tip the market to a buyer's market in the sale market. And again, similarly, if we take that stock out of the rental market, it can make the rental market more competitive. So this chart shows the number of condos in City of Toronto listed for lease for the month of September. And we can kind of see that that's been declining. So in 2023, it was just over 1,000. At the peak of 2021, it was about 1,200. So it's been declining over the past couple of years. And it's lower than it has been over the past 3 years. So again, this could be yet another, sign that some investors are taking some of their properties, exiting them gradually. So again, I think there's going to be another important sign to keep an eye on, because this shift could obviously impact not just the resale market, but also the condominium rental market as well, if we're taking some of that stock out of the rental market. So that is that for now. I'm going to, before we jump it on with Dave, maybe I'll ask Urmi if we have any questions from everyone.
Hi, everyone. Yes, we do have a great question here from, let me just get to, from Andre. As a young person looking to get into a condo, I keep an eye on listings. I notice the prices are going up by 4 times from 2015 to 2023. Is that normal, or will the prices adjust? For example, a condo was listed for $155K in 2015 and is now listed for $405,000 in my part of town.
So that's a great question. So, I mean, definitely condos should not have gone up 4 times in that time frame, and that is not a normal rate of appreciation. So depending on where you're looking, like condo market and prices are cooling. So, you know, again, that rate of growth isn't typical. We're seeing some prices ease off a little bit. You know, so if someone's considering getting into the market, you know, they have a decision if they want to kind of wait to see if prices dip further. That's what a lot of people did, quite frankly, between September of 2022 and December of 2022. That's why the market was very cool. And I suspect that's maybe partly why we're seeing just some people not rush to buy, even if they can afford it, right? So I think it's a very personal decision looking at the market that you're buying in, if you want to buy now, or if you want to wait, if you anticipate prices dipping further. I'm gonna guess that this has got to be in a region outside of kind of the immediate GTA, you know, maybe Barrie or something like that. Like, I can't imagine there are too many condos, you know, in the 400s in like Toronto or York or anything like that. So yeah, and those regions might see a little bit more pressure potentially, who knows? So it's a personal decision if someone wants to just wait to see if there's a further cooling.
Great. Thanks, Andre. And if you have more specific details, you can always email John directly at askjohn@movesmartly.com if you want to share more details about where you're looking in. One more question before we turn to Dave, John. For investors, do you suggest selling now because it's cash flow negative, or wait for the market to recover? So a market timing question. I know you love that.
It's such a huge you know, it's such a huge question. And I think it's the question that a lot of the investors we talk to are facing. Because just so everyone understands, like the whole cash flow negative question is, you know, for some investors who have to renew their mortgages at today's rates, they're going to be for many of them, especially if they have a mortgage that is, you know, 75 or 80% of the value of the home, they're going to be significantly cash flow negative. Like they're going to be short 1,000 or 1,200 or 1,500 a month. So, you know, and if you and this is the biggest issue for people who have multiple properties, right? If you have 2, 3, 4, 5, and you have to do that on all of them, you're going to be hurting. So, you know, I guess the question for some investors is if they can hold on. Like, I would not be holding on, hoping things are better in 6 or 12 months. I think this is a mistake that some people are making. You know, they just think, well, the market's not great now. I'll list it in January. The market's normally busy in January. I mean, I say it's a mistake, but, you know, we all eat our words. No one can predict the future. But the reality is, I think most people, and David's going to join us, if rates stay higher for longer, the probability of the market getting much better in the new year is probably low. You know what I mean? And I think that's the best way to think about things. We can't predict the future. We just have to think about what are the most likely outcomes. And higher prices next year are a very low probability event, right? So as an investor, you have to be willing to hold on for a long time. So you have to be willing to support that negative cash flow for a number of years, because that's how long it might take for the market to kind of, you know, rebound or increase again back to sort of even spring levels. So again, personal decision. I mean, I think generally, you know, if I'm an investor, I normally wouldn't like to sell. But again, if I can't hold it and it's, you know, I can't manage that negative cash flow, you know, then I would probably unload it sooner rather than later. And yeah, I mean, you're going to be a little bit down from the peak, but I mean, you have to, you know, you have to do what you have to do to get through the next couple years or whatever it's going to be, where it's probably going to be challenging with rates staying this elevated.
All right, I don't want to keep Dave waiting too long. I'm just going to squeeze in this second question because it's kind of related here. What are the advantages of waiting a year to sell after closing on a new build investment property? What I'm hearing from you, John, probably is not much.
Well, I mean, you potentially avoid some tax implications, right? You know, capital gains if you're just using it as a flipped property, if that's how it's perceived, HST, stuff like that. So you may want to hold on to it for those reasons. And we've had clients who've been talking to their accountants specifically about this, who, took possession of newly completed properties, need to sell them, and they're just looking at the tax implications depending on their personal circumstances. So,
right. That just slipped my mind, right, John? So if it is for flipping purposes, there is an attempt to see whether you've actually occupied it.
yeah, potentially, right? And I think and again, I'm not gonna get into sort of what is, and I'm not a tax expert, but like an accountant will be able to advise you what are the risks of, if you get audited, that this will be perceived as a purely speculative investment property that you just flipped and made potentially a capital gain on, and have to pay taxes on. So I would talk to an accountant about some of those questions, because that might help, guide the decision making.
Great. Okay. And I have a question already for Dave, and maybe we'll hear some more as well.
All right, Mr. LaRock. Okay, everyone. So we have David LaRock, excellent master mortgage broker, integrated mortgage planners, writes for Move Smartly as well, for those of you who don't follow his great content. So we're always lucky to have Dave joining us to chat a little bit about sort of the mortgage market, interest rate market. And I want to kick off today because when I read your latest blog post, I felt like a bit of a shock. I scrolled down to the latest interest rates, and I saw the latest interest rates for properties over 1 million, so properties that are not insured, I believe was 6.7%. Or something like that. Is that correct?
Those are 3-year rates, 3-year fixed rates. 5-year fixed rates are lower, but I think right now 5-year fixed rates, I'm advertising the rates people are most asking about and choosing these days, and 5-year fixed rates to me don't have a lot of appeal. Again, no confidence in my crystal ball any more than anyone else's, but those are 3-year fixed rates. And yeah, 6.7 is, again, there's a bit of room there, John. I always, with the rates I advertise, I always under promise and over deliver wherever possible. But yeah, that's about where the 3-year fixed rate is right now if you're buying for more than $1 million and it's uninsured.
Wow, unbelievable. And kind of going back to sort of the start of our discussion today, why sales are so low, why detached sales are at a historic low. When you're paying 6.7, you're getting qualified at 8.7 because of our stress test, which makes it so much harder to afford a house these days. And this is sort of the biggest factor. So unbelievable. But I thought I'd kind of kick it off, Dave, maybe kind of you unpacking some of the latest things that you are seeing, in the bond markets, how that's impacting obviously fixed rates, and then obviously the outlook you kind of talked about for the Bank of Canada's next rate move.
Yeah, sure, John. Well, the reality is the slowdown in the housing market is exactly what the Bank of Canada wants, and quite frankly is part of what we need to ensure that inflation cools sufficiently, because right now inflation is rising again. We bottomed at 3.2% in June. We were 3.3% in July, and we were up to 4% in August. And barring a real surprise, we're probably going up again in September. Part of that is base effects, which I've written a detailed post about before. But long story short, every time we add a new monthly print, in this case, we will add next week, we will add the September inflation print. Last year's September print falls out of the basket because we always look back 12 months. So we had a heavy tailwind in the first half of this year where the months that were falling out of the 12-month data set were really high price months with lots of increase. And that meant that even though the months we were adding on the front end were still showing prices clipping along at about 4.5% to 5% on average price increases, the stuff falling out of the back end, annualized, should always add that. Yeah. The stuff falling off the back end was even, the price increases a year ago were even hotter. That effect has gone away. Over the second half of last year, price increases really moderated. So when those months are falling out of the back end going forward, they're not helping as much. And we're still adding fairly hot months on the front end. For example, last month, prices went up by 0.4%, which annualizes out to 4.8%. That is still very hot, and especially when you're trying to get back to 2%. That matters for anyone keeping an eye on mortgage rates, especially variable rate borrowers wondering when rates might start to drop and the Bank of Canada might start cutting, because the real estate market is effectively frozen until we see lower rates. People aren't going to line up en masse to buy properties at these rates and with qualifying rates that are 2% higher. In terms of what we're seeing, John, interestingly, we've had, we learned last week that average wages went up. Again, last month, they increased at an annualized rate from 5.2% in August to 5.3% in September. We got another strong headline print in the jobs data. Oil prices are higher now, so that too is going to put upward pressure on all prices. Energy costs are pervasive. Energy and labor costs are the two most pervasive costs, and both of them are on the upswing. That's another reason why I think the next CPI print we get will be higher again. But interestingly, John, the bond market for a long time wasn't buying the warnings from the Bank of Canada and the Fed that rates were going to have to stay high for longer. And when bond yields weren't pricing in a full higher for longer view, it looked like the BOC was probably going to have to increase by another quarter point. The bond market had a 90% probability when we got the August CPI data, then the July CPI data, then it dropped to a 10% probability when the GDP print came in lower and showed that we were flat in the second quarter. Then it shot up again. It was at 25% early last week, and then we got the news that the employment data were stronger than expected, and it went up. The odds of a Bank of Canada rate hike this year went from 25 to 40%. So it's really all over the map. But in the background, bond yields have been going way up. In the US, certainly, and the Canadian Government of Canada bond yields are dragged along by their US equivalents. But what's happened in the bond market, because yields have gone up so much, that has produced a similar tightening, financial market tightening, that you would otherwise need from the Bank of Canada and the Fed. So ironically, the bond market's buying into the Fed and the BOC's warning that rates will have to stay higher for longer has caused yields to go up. And that has effectively done the work that more BOC and Fed rate hikes would otherwise have to do. And interestingly, while it may seem counterintuitive, that buy-in from the bond market, that pricing in of a higher, longer for view, actually lowers the odds that we will see another BOC rate hike, certainly on October the 26th. But also for over the rest of the year. What that does is it buys the BOC and the Fed a bit more time. We know we've had 10 rounds of rate hikes. We've got record high debt levels in Canada, both government and consumer. These rate hikes have to start to bite. The pandemic savings that were buffering people for a long time and allowing them to maintain spending, even though rates were higher, and basically not respond the way that would be expected when the Bank of Canada enacted all those rate hikes. Basically, those pandemic savings were interrupting that transmission mechanism between BOC rate hikes and slowing the economy. The other thing that's changing now, John, is those fixed payment variable rate mortgages are starting to be reset. The leniency that was given to people when they hit their trigger rates is going away. I'm clients of mine who are customers of TD used to be told, hey, as long as you've got enough equity in the property, if your minimum mortgage payment that we locked in for you when you started out with your variable rate at less than 2%, if that payment is now not even covering the cost of interest, we're going to let you roll that shortfall into the mortgage each month. So even though rates had gone way up, those borrowers were protected on a cash flow basis, and there was no impact on the money they had to spend each month. Well, recently, some of my TD clients of the same profile as the ones that used to be told they could have the flexibility to roll the shortfall into the mortgage and actually negative amortize it, which basically means the mortgage is increasing each month, not decreasing. That same profile of borrower is now being told that they have to increase their payment, that they've hit their trigger rate, and the payment needs to be reset based on the original amortization at today's much higher rates. Well, that's an increase for some borrowers of as much as 50%. So these things are starting to really bite and impact the economy. We're seeing a slowdown. The BOC and the Fed want more time. But here's the catch. Inflation expectations are becoming unanchored. We're seeing union negotiation where contracts are negotiating higher wages that are being baked in for years ahead. And the debates are whether we should get 5% annual increases in those contracts or 10% annual increases in those contracts. We're also hearing debate now that we shouldn't have an inflation target of 2%. The inflation target should really be more like 3%. That feels like a better number. So when you're the Bank of Canada and you're seeing all of these things happening, long-term wage negotiations with major unions, which, by the way, those unions, the workers for those unions aren't large as a percentage of the overall Canadian population, but they form the base rates through which all kinds of other wage negotiations take place. So they are precedent setting, and with wage expectations rising, and with all the other pressures that we're seeing in the economy, the debates about a higher inflation target, these are examples of inflation expectations becoming unanchored. And when that happens, people change behavior, they bring forward spending, they put lots more demand in the economy, and it leads to much higher inflation. The Bank of Canada is terrified of that outcome. So they don't have the luxury of waiting a year for all of this to play out. They're confident that the rate hikes they've made will slow the economy, but they need that to happen for as long and quickly enough for inflation expectations to remain anchored around the 2% target. People have to believe we're going to get back to 2%. And if they're worried that we're at a point where people stop believing that that'll be the case, they may have to hike again regardless. But the fact that the bond yields have gone up so much and fixed mortgage rates have risen substantially, I mean, the reality is everybody's taking fixed rates today. So from a market impact, a real estate market impact standpoint, the BOC's next quarter point hike won't have nearly the impact that all of the fixed rate increases we've seen lately as a result of bond yields rising will have. And effectively, the bond market is doing the work that the BOC would otherwise have to do.
That's super interesting. When you chat about inflation expectations being unanchored, I mean, it reminds me of a conversation I had a little while ago with a friend who is in the construction business. They supply condos, actually. I mean, they're one of the suppliers for condominiums. So they sort of, make their quotes a year and a half, 2 years in advance before they're actually going to do the work. And I was talking to him, and obviously the work that they've been doing over the past year was bid on years ago or a couple of years ago. And prices are higher. I mean, materials are higher, labor's a little bit higher. So their margins are a lot lower, which makes them a little bit worried, because now when they're bidding on projects, they're of course bidding expecting prices to be a lot higher a year or two from now than they are today, because they don't want to be caught off guard by these rising prices. And I think that's kind of what you talk about. It's like, it can almost be this self-fulfilling prophecy of businesses who are quoting projects a year or two out, expect prices to be 5 or 6% higher. They bake that into their contracts, and it's almost like inflation is kind of contracted in from today over the next 2 years on some of these projects. So or even worse, John, they decide that maybe they think they can't get that kind of pricing out of the market right now, so they decide not to build, which means there isn't a supply response, which means when rates do come down eventually, there's still a demand supply problem and prices take off again. That's another way that inflation expectations becoming unanchored today can lead to higher inflation later. It takes longer for that to kick in, but it's still inflationary. Yeah, that's interesting. One thing I wanted to ask you, because I mean, you see it on the ground, we've seen it. I mean, maybe you see it before us. To what extent are you seeing a lot of distressed households? And by distressed, I mean, people who can't handle, like you said, I mean, for some people who are renewing, their mortgage payments going up almost 50%, right? So whether they are a household, or whether they are an investor, like how many just can't afford it? And I've certainly, anecdotally, I've heard of stories of households who can't afford it and are just selling their family home and downsizing and renting, and some investors. I mean, but on the ground, personally, I haven't seen tons. I've talked to investors and they're certainly thinking about selling, but it doesn't seem many of them are like in full on panic mode yet. So what are you seeing? Is it still early, or are you starting to see kind of panic in the market from some people?
Well, like you, John, so far I'm seeing it more at the margins. It's not the main story. Most Canadians, up till 2019, most Canadians were opting for fixed rate mortgages. So when I look at my renewing clients today, those are the ones who are experiencing the payment shock in real time. Those borrowers, by and large, are coming off of fixed rate mortgages. Most of those are 5-year fixed rate mortgages. So they've got 5 years worth of pay down built into their reset rate. So the fact that if your last mortgage payment on the mortgage you had at 2% was set originally based on your original mortgage balance. But after the 5-year mark, when you're renewing a lower mortgage. So even though rates are higher, some of that is offset by the fact that the rate you're renewing at is lower. The other option that borrowers have who bought or who are coming out of mortgages now that are at the end of 5-year fixed rate terms, in many cases, there's still lots of equity in the property. And if they can qualify, which most of them can, we can look into resetting the amortization back up to 30 years. The rates that you pay for a 30-year AM versus a 25-year AM are higher, and that offsets some of that savings by stretching the AM out. But the bottom line is, John, in most cases, we can, here's the thing, and again, I worry about saying this because it's going to make me sound insensitive, and I am not. I understand a lot of people are struggling now, and I sympathize with those people. But in my experience, when people see rates triple, and they don't yet have the numbers run on their individual situation, they're surprised when their payment only went up by 30 or 40%. In fact, pleasantly surprised. They think because the rates went from 2% to 6% that the payment could go up by 3 times as well. And the reality is most of the people that I'm speaking to, established homeowners who have fixed rate mortgages, who are renewing lower balances, who have the option of re-extending their AM, those borrowers are managing. But I do get calls, usually from a variable rate borrower, who will say, I'm really struggling. And, unfortunately, it's always worth having the conversation with me, and then if need be with the lender. But the reality is the options for those borrowers are limited. There's no magic bullet right now, and more people are struggling. And again, I am totally sympathetic to those people. The reality in my experience, John, is that tends to be at the margin. Thus far, most people can handle the higher payments. Where I think we're really in for a test is when those 2020 mortgages renew, because that was when the Bank of Canada governor told Canadians that they could count on rates staying low for a long time, and where a disproportionate number of Canadians relative to precedent shifted into variable rate mortgages at less than 2% and have since seen them climb up to 6% or higher. Now, the variable rate borrowers who have adjustable payments have had to shoulder all those increases and are already living with higher payments. But 2/3 of Canadian variable rate mortgages come with fixed payments, and many of those borrowers either had the increase in payment shock delayed or entirely postponed, and are just now at the point where they're facing the new reality of the impact that these higher rates has on their cash flows. And I think if you're the Bank of Canada, and I talked about this before when you and I spoke, the BOC knows that what is coming with those renewals in 2025 is a problem of their making. And I think if I was the BOC and I thought raising a 1/4 point on October the 25th would reduce the odds that we'd have problems in 2025, I'd probably raise now and try to mitigate for 2025, because that's when the real test of the strength of our mortgage market is going to happen.
And just unpack that for those who aren't 100% clear why Dave means 2025. And 2020 was really when rates plummeted due to COVID. And I think that's what Dave means. So those are the buyers who got mortgages, 5-year mortgages, probably below 2% in many cases, right? In the ones. So those, it's one thing, like anyone renewing today, probably had a 3 or 3.5% mortgage, and fine, they're going to 6. That's obviously a big increase. But, it's 2025, those people who are going from say 1.5 to who knows where rates will be in 2025. But even if they are where they are today, 6, 6.5, there's a massive, massive increase. So that's why David's kind of talking about 2025 being a big test. I mean, we have another year plus to that. So we'll see what happens between now and then.
Yeah, I think rates will be lower in 2025, John, but to your point, back in 2020, variable rates had been on a 25-year run where they'd beaten fixed rates about 90% of the time. You could have a fixed rate at 2% or a variable rate at 1.5%. 2% seemed like a lot higher, and people wanted to pick up the savings. They were taking on larger mortgages. 2020 was the peak as far as demand and how busy the market got. I know the prices went up after that, but in terms of how it felt as a mortgage broker, that was really the biggest year. We were all locked in our houses and had nothing better to do, so it was fine to keep underwriting a bunch of mortgages. And again, we had the reassurances from Tiff Macklem that the Bank of Canada wasn't going to raise for a long time, that Canadians could count on that. The BOC's own forecasts were showing that its policy rate wasn't going to start to rise until the second half of 2023. So you're taking out a variable and you've got 3 years at 1.5%. In your mind, you're thinking, well, even if rates start to go up after the second half of 2023, I've saved so much between now and then. Basically, I'm just giving back the pile that I've saved. And it seemed like a no-brainer to people. And again, most variable rate mortgages, the vast majority are 5-year terms. So people who took variable rates in 2020 are renewing in 2025. And that's the box on the BOC's calendar circled with red ink that they're keeping an eye on. And the reality is, I think rates will probably be lower in 2025. But if you're the BOC, you are sure hoping that's the case.
Yeah, super interesting. Urmi, I don't know if we had any questions to kind of go over from.
Yes, we do. We have quite a few. Hi, Dave.
Hi.
I'm going to ask that question we had a little bit earlier from somebody that is about to close on a condo investment. Given what all the discussion that you and Dave just had about, whether we might see some of these listings, would it make sense to rent it out even at a cash flow negative, even if that's the case, for a year and then sell? I think, John, you were saying, the longer you wait, you might want to think about it. So let's keep the capital gains question that you first addressed aside, John.
Mm-hmm. So the question, should they just rent it out rather than sell it?
Yes,
or wait for a year. And is there any positives in doing so?
I mean, I don't think waiting a year is going to change much. Like, I don't, it's so funny because I was speaking this, and I don't want to eat my words. I was speaking at this conference, and it's kind of funny because for 2 years in a row or 3 years in a row, this conference hosted by a company in Veritas, they do these surveys, and every year they ask participants, and these are all bankers, very smart people, where are home prices going to be a year from now, right? And for the past couple of years, the expectation has always been prices are going to be lower. And I think in both cases, they've been largely wrong, right? I mean, so we don't know for sure, but I mean, I think now the likelihood is a lot higher that we're not going to be higher a year from now. We're either going to be flat as kind of a best case scenario, or lower. So I don't know if waiting a year is going to help. And that's why I said earlier, you need to, if you're holding and you don't want to sell, buckle down for 2 to 3 years. I mean, I don't know how long it's going to take, but for prices to recover, you're going to have to wait a while. If you don't like today's prices, for example, I think that's the important point. If today's prices are not good enough for you, which are basically last year's prices, then you're going to have to buckle down for a lot longer. And today's prices are still decent. I mean, I think we're very spoiled because we saw the run up in 2022. And it's funny. I mean, there's a lot of behavioral economists talk about how investors who buy real estate or homes is a very good one, when they calculate their losses or their gains, sort of the anchor point that they use is different whether it's a loss or gain. So when we talk about our gains, the price that we're comparing to is the price we bought the property for when we originally purchased it. But when people calculate their losses, it is the theoretical peak that they could have sold for, and they see that as a loss, even if they're actually technically up because there's a gain from when they bought it. So even if they bought it for way less than what they're selling it for today, in their minds, they actually are thinking about this sale as a loss because they're selling it for less than the peak, say a year and a half ago. And I think we just have to be mindful of that. And if we are selling for a gain, just think about it as a gain and not as a loss because we missed the peak of February 2022.
Wise words. Thanks, John. And Dave, of course, mentioned that 2025 date. So it seems like that, like you said, things are unclear for the next 2 to 3 years at least. Hmm. Dave, a question for you from Adriano. Are you finding the majority of your clients that are renewing are trying to push back their amortization terms out, making them longer?
The majority, no. Some certainly are. Those that are most feeling the hit of the higher demands on their cash flows, for sure. But no, in fact, it's interesting. When rates were really low, looking back, that would have been a great time to take extra money and pay off the mortgage. People didn't want to throw money into a mortgage that was costing them less than 2%. They thought there were better things to do with the money. Now, when rates are higher, people want to keep their amortizations low. They hate debt. They see it more as a threat than as a leverage tool or as a useful tool. And the mentality that I see in most borrowers, again, if you're trying to keep from drowning, you do whatever you can do to survive. But if you're in a position where you have to tighten your belt to keep the amortization the same, in some cases, those amortizations are 15 years or 10 years. People are determined with rates this high to keep doing that work. And in some cases, Urmi, those people have been helped. They're in a better position now because they had the discipline of paying off the mortgage and maybe making extra payments. And higher rates today have strengthened that conviction in many cases. So no, it's certainly not the majority.
That's actually, and to me, that's super interesting because it is the opposite of, I think, what most people would think. I think most people would think that the majority of people are extending and are struggling. So it's interesting to hear you say that the majority are not in that position. So, I mean,
well, I can only speak for my borrowers, of course.
Yes.
But yeah, I mean, the reality is we read a lot of headlines about, the most over-leveraged borrowers or the most extreme examples of people doing irresponsible things. But as a guy on the front lines who spends all day, every day talking to borrowers, even when rates were quite low and people looked ahead, they thought responsibly, they had good advice from parents, they surrounded themselves with a team of good people, whether it was their realtor or their mortgage broker, and they took good advice and they really took the decision seriously. And again, I get a little bit annoyed sometimes because for all that you read that makes it to the mainstream media, you would assume that things are much more dire with the average borrower than they are. The reality is everybody's feeling the pinch, but most of the people that I worked with planned ahead and imagined days like this could come and have not left themselves with no options.
Great, thanks, Dave. And Adriana also says, thanks, Dave, great point. I think maybe a fitting last question here for both of you. So what's the scenario if we hit a recession? Presumably, do rates come down? And if so, how does that impact house prices? So not sure which order we want to tackle this.
Well, why don't I start with interest rates, John, and then you can talk about house prices.
Sure.
In modern times, rates have fallen in every recession that we've had. So the odds are very good if we see a slowdown that rates should fall. That would not be an unreasonable assumption to make. The question, I guess, then would be how much would they fall by? But there's a but. It's an important one. These are not normal times. These are very strange times. And normally in a recession, the Bank of Canada would be cutting rates in order to stimulate growth, to try to offset the weakness in the economy. The challenge this time around is that even though right now the economy is slowing, inflation's going the other way, and the Bank of Canada has repeatedly reiterated it has one mandate, and that is price stability, which it defines as maintaining an inflation target of 2%. If push comes to shove and the bank has to choose between a slower economy and bringing inflation back to 2%, it's been very clear that it will keep rates as high as it needs to achieve the inflation objectives. So even though the odds say that rates should fall during a recession, these are very unusual times. And if we end up in a stagflation scenario, which is basically one where we have a recession, but we have and we still have inflation, The Bank of Canada has to focus on inflation. That is its mandate, as given it to it by its political masters. And again, John, let's assume that we get a recession and we see some softening in rates. Then I think in that scenario, you would be the expert on what you would expect on prices.
Yeah. So, I mean, I'm going to touch on your point because I think it's an important one. That I think some realtors, I mean, I look at a lot of what people comment on and some of the stories realtors put forward. And certainly one of the things a lot of real estate put forward is this bullish narrative that if we have a recession, rates are going to fall and the market's going to go on fire again, right? And I think, again, this is like a very narrow view. And I do agree with David that, yes, that is the historical normal trend, but these are very different times. Like these are going to be potentially times that are more similar to like the 1970s and 80s that David's talking about, where potentially we have a recession and high inflation and rates don't come down in any material way. And in that environment, like it's unprecedented. We haven't had that in a very long time. And it is not good. Like to be frank with you, like it is not a very good environment, because if we have high rates, and I mean a recession, like a real recession, not like a moderate decline in GDP. Recessions are coupled with job losses, right? And the biggest difference between like a housing slowdown and a housing bust usually is unemployment, right? So if we see high rates of unemployment, and of course, especially among homeowners, we probably saw, I think, a little bit more among lower income households during COVID, because those were obviously because of the employment situation and small businesses shut down. But if we see higher than average job losses among homeowners, well, yeah, this dual combo of high rates, high mortgage payments, mortgage payments going up 50%, and even one person in the household loses their job, it is not a good outcome, right? So, again, this isn't a prediction, obviously. Like, we don't know where rates are going to go. We don't know where inflation is going. But the assumption that if we have a recession, rates will fall and the market will rebound, it is not an obvious one. It is not a guaranteed one, because as David said, a lot of that has to do with where inflation's going. And I agree with him that the bank is going to be more focused on inflation than any short-term turnaround in GDP. They want to crush that before they focus on growth. So,
and maybe I'll end with my own follow-up. Just remind us with stagflation, inflation, people don't understand how it can remain high in a recession. Are we expecting, for example, fuel prices and those other factors that have led to this high inflation around the advanced world, industrialized world, to continue? And it's possible that we might see that in combination with a shrinkage in GDP. Because,
absolutely. Yeah.
And I'm just going to follow up, Dave, because people are a bit confused, because on the one hand, we hear the governor talking about how wage growth is part of the inflation story. We would assume that a recession would, mitigate that, but there are other inflationary factors. So I'm wondering if you can unpack that for us.
Absolutely, Urmi. Well, the key point there is that the Bank of Canada's monetary policy and policy rate don't influence all prices. Some prices are entirely beyond its control. And when you think about the most obvious stagflation scenario in the 70s, it was during an oil crisis where the price of oil went to the moon, and basically it killed the economy, but it didn't. The slower economy wasn't bringing prices down because the global energy prices were beyond the purview of central bankers. So it's not a high probability scenario. A lot of factors have to line up, but when you have a lot of debt outstanding, which demands an increasing percentage of the available funds, the available capital diverted towards debt payments, and you have spiking energy prices, and we've seen geopolitically now there's a lot of instability that could affect energy prices. The combination of those two things, really, when you look at the key pieces that have to be in place to hit into a stagflation environment, those are two of the big ones. So,
yeah, as if Russia wasn't bad enough, we now see the Middle East again back in serious disarray.
Right. So again, I don't like to sound alarmist, but I think that but we should be very clear-eyed about what we're heading towards. There's a lot of uncertainty, and some of the outcomes are bad. And anybody suggesting that if we get a recession, interest rates are going to fall, and that's going to be great for house prices, is glossing over John's very key point, which is that the prime determinant of mortgage repayment is not how high rates go. It's whether or not people keep their jobs. And when people start losing their jobs and mortgage payment defaults start going up, the appetite of lenders changes overnight. House prices start dropping. People don't get their bonuses if they're lucky. If they're unlucky, they lose their jobs. And a recession, the reason rates fall in a recession is because there's less stimulus and inflation and demand in the economy. And all of those things are bad for house prices. So it is not a simple, in a normal environment, falling rates are good for house prices. In a recessionary environment, falling interest rates are a byproduct of a whole lot of weakness in the economy, and all of that weakness in the economy is bad for prices to much more of an extent that lower rates are good for house prices.
Great reminder. Yeah, from thanks to both of you. I think this might be a good place. I think that might be the end of our questions. There are some more specific ones again. Can I have you both share your emails again if people have more specific questions?
Sure.
Yeah, I'm at askjohn@movesmartly.com. Dave?
I'm Dave at moreplan, morplan.ca, and my contact details are at the bottom of all of my posts as well.
Yes, and I've posted that Dave's post here and in the show notes to this video, where you can also find John's latest report as well with his contact information. Thank you both.
Awesome.
And thanks to all our viewers and listeners as well for their great questions.